Welcome back to Intermediate Accounting, and this video is on current liabilities. Most of the current liabilities that you see here in items 1 through 6 have been covered or will be covered in the future. This video is going to focus on items 7, 8, and 9, sales tax payable, employee-related liabilities, and current maturities of long-term debt. Let's get started with sales tax payable. As you know, when you buy something, the companies are charging you not only the sales price, but they're also charging you sales taxes. Companies collect those sales tax, but they don't get to keep it. At some point in the future, they need to send those sales taxes in to the government, typically to the state. Let's see two methods of accounting for those sales taxes that are collected by the company. Here's our first example. Prepare the entry to record sales taxes, assuming there was a sale of $3,000 when a 4% sales tax is in effect, and the company records sales tax as a liability when the cash is received from the customer. So obviously the first thing we need to do in this journal entry is to record the fact that we received cash from the customer. And how much cash? Well, let's look at the other sides of this journal entry. The company records an increase in sales revenue with a credit to sales revenue at the sales price of $3,000. And the company also collects the sales tax. If they record that sales tax separately from sales revenue, 4% of the $3,000, $120. If they record it separately from sales revenue, they'll increase a liability account called sales taxes payable. And so how much cash did the company receive? The total amount, $3,120, or 1.04% of the sales price. However, some companies don't segregate or separate the sales taxes from the amount of sales revenue at the time of the sale. To make it easier for some companies, sometimes they'll just lump together the amount of the sales revenue together with the sales taxes that are collected and credit both into sales revenue accounts. Makes it a little bit easier for the company, but of course the amount due to sales taxes must eventually be removed from the sales revenue account. And that would be done either as an adjusting entry at the end of the period or at the time that the sales taxes is actually sent, the check is made to send those sales taxes from the company to the government. Let's take a look at an example here. Sales of $150,000, including sales taxes of 4%, were recorded to revenue. So over the course of the accounting period, every time the company had a sale, it recorded the entire amount charged to the customer, including sales taxes, to revenue. So the original entry, or entries, every time sales revenue took place, the company would debit either cash or accounts receivable, and that ended up totaling $150,000 across the period, and crediting sales revenue. So we know that this sales revenue of $150,000 includes the amount of sales taxes. So at the end of the period, let's say we have not yet submitted payment to the government. We're recording, let's say, an adjusting entry. The company needs to make an entry to take out from the sales revenue amount the amount that's due to sales taxes payable. So how much is that amount that's due to sales tax payable? The calculation that we have, tax calculation. We start with the total sales price, $150,000, the total amount that was booked to sales revenue, and then we divide it by 1 plus the tax rate. Here's our total revenue, including taxes. Divide this by 1 plus the tax rate. And when we solve, we get $144,231. And what this is, this $144,231, it represents the sales revenue before taxes. So that's the amount that we want to keep in the sales revenue account. So we've booked $150,000 into sales revenue, but we want that account to actually be $144,231. So if we think about our sales revenue T account, we have a $150,000 balance, we want that balance to be 144,231, and we want that difference to come out of sales revenue and go into sales tax payable. That difference is 5,769. So the amount of our entry is the difference, 150,000 less 144,231, and that equals 5,769. Now we still need to record that journal entry. So the entry is going to be an adjusting entry. We're going to debit sales revenue. Now that should look strange. We've never debited sales revenue before, except if we had a return of merchandise or an allowance that later on reduced to revenue. So we debit sales revenue to reduce revenue for 5,769, and we credit sales tax payable to increase that liability, the amount owed for sales taxes. Why would a company do this? Well, it's easier to do it this way. Every time you're booking a journal entry, you don't have to track separately account for the sales taxes payable. Just do it one time at the end of the accounting period or at the time the payment needs to be made to the government. We just strip that total amount out of sales revenue and put it into sales taxes payable. This, of course, would be the adjusting entry if we have not made payment yet. Sometime in the future when payment is made, we would then debit to reduce sales taxes payable and credit cash. We're going to look at 3 different types of employee-related liabilities: payroll deductions, compensated absences, and bonuses. Let's get started with payroll deductions. This is really important to keep in your notes. Every time companies record payroll, the fact that they're making payment to their employees for the services provided, it's the end of the pay period. Typically that's going to be either every week, every other week, or at the end of the month. Companies are going to record 2 journal entries. The first journal entry is salaries, debit to salaries and wages expense. In the past, when we've talked about we reach the end of the accounting period and we need to record the adjusting entry for the services owed but are unpaid, we have salaries and wages expense as the debit and salaries and wages payable as the credit. Now, when payroll actually takes place, we've never looked at the accounting before. So it's more than just taking off the payable and debiting and crediting cash. This is the time where, since our last adjusting entry, we're recording the expense for any work that's been performed but has not yet been recorded as an expense. Then we're going to credit more than just cash. Companies need to pay taxes to the government, several different types of taxes. So this expense that we're recording first is the taxes that the employee actually has to pay, but the company is collecting it on behalf of the employee. This first credit is for what's called FICA taxes payable. And really important to remember is that this is the employee's portion. It's being withheld by the company making payroll on behalf of that employee. And we'll talk a little bit more about FICA taxes payable at the next slide. The company also needs to withhold the necessary federal and state taxes on behalf of the employee. They're going to record that into an account called withholding taxes payable. In addition, the employee may elect to have certain other withholdings, such as retirement contributions or union dues that are paid, or sometimes if the company runs a health club, gym, and maybe the employer is going to automatically withhold the gym membership fee. We would, depending on what that specific withholding was, I'm just going to call this a general voluntary withholdings account. This is not actually the account title, but it would be a credit for voluntary withholdings, such as maybe the account might be union dues payable, employees in a union, or retirement contributions payable. Whatever that specific account would be, put payable at the end of it. And then everything that's left over, the amount of the employee's paycheck that has not been withheld for any of these 3 items, is a credit to cash for the company. Remember, this is on the employee's portion. So the company is withholding money not for itself, but on behalf of the employee. In addition, the company also has to pay some taxes. And they were going to record that in a separate entry called payroll tax expense. So the debit would be to the account payroll tax expense. So if your employees know that they're contractually entitled to receive $100,000 for this pay period, that $100,000 goes into salaries and wages expense. In addition to that, the company has more that it owes and a greater cost. Not only does the employee incur the FICA taxes payable, the employer also pays a portion or owes a portion of the FICA taxes payable. Again, we'll see more of that in just a moment. So a credit to FICA taxes payable. This is now the employer's portion. And then there's a second tax that an employer has to pay that the employee does not pay, or in this case, owe. And that is FUTA and SUTA taxes payable, federal and state unemployment taxes payable. And we'll cover that in more detail again in just a moment. All right, so let's take, now that we know the journal entries, these are really important notes to have every time we have payroll. We're going to book these 2 entries. Now let's take a look at each of these withholdings in just a little bit more detail. So FICA and Medicare, sometimes the tax combined is sometimes referred to just as FICA or as Social Security, but it relates to 2 components. These withholdings are typically recorded in an account called, we saw it in the previous slide, an account called FICA taxes payable. These are withholdings. The company has to eventually remit them on behalf of the employee and the company itself. They remit both portions to the government. And what this does is it goes to refer, you've probably heard about Social Security benefits that are given to Medicare to the elderly and people who often just need some extra assistance. And they are payable by both, as we saw in our last 2 journal entries, by both the employer, that was in our second entry in the payroll tax expense entry, and by the employee. So if the FICA tax is 7.65%, that would be charged by both. That needs to be paid out by the employee and the employer. Unemployment taxes, we know what that is, right? The employers only pay or owe and then pay unemployment taxes. This is a benefit that the government pays out to people that are unemployed and do qualify for unemployment benefits. The Federal Unemployment Tax Act, we refer to that as FUTA taxes payable, and the State Employment Tax Act, we refer to that as SUTA, State Unemployment Taxes Act payable. And again, only the employer, only the company that is making the payroll owes the unemployment tax. The employee does not have to pay that. And it's typically recorded in the accounts FUTA taxes payable and SUTA taxes payable. And one more, the income tax withholding. Federal and state income tax laws require employers to do the withholdings on behalf of the employee's pay, right? So the cost is being incurred by the employee for their federal and state income taxes, but the employer is the one who's actually doing the record keeping, withholding that amount and then remitting it to the government at the proper time. Why do we have all these withholdings? Because the company's not making payments to the government every time they do payroll. They're probably going to do it quarterly, just 4 times a year. So every time payroll is done, whether it's weekly, every other week, or once a month, they're withholding it, and then typically 4 times a year they're actually making the payment, taking down the liabilities or the payables and crediting cash when they make the actual payment. So when the employer is withholding the income tax on behalf of the employee, it's recorded to the account withholding taxes payable. We saw this in our journal entry a few slides ago. We saw that here, the withholding taxes payable, the FICA taxes payable, FUTA and SUTA. We just looked at each of these in a little more detail. And again, here's a summary slide that shows that the employee is the one who's actually paying out, with being withheld and incurring the cost of the income tax withholdings, the FICA for their share, and union dues, retirement contributions, health insurance premiums, anything else that's being voluntarily withheld. The employer is responsible for the FICA taxes, federal unemployment, FUTA, and state unemployment, SUTA. Let's take a look at an example. Assume a weekly payroll on behalf of the company of $10,000. The entire amount is subject to FICA and Medicare. They total 7.65%. That's the current rate. The company also has federal state unemployment taxes of 0.8% and 4% unemployment taxes for state. The income tax withholding on behalf of the employee is $13.20, and union dues on behalf of the employer are $88. Record the entry for salaries and wages paid and the employee payroll deductions. So in other words, let's do the company's payroll. Remember, there's going to be 2 journal entries that are recorded, and we need to know what amounts that are all jumbled up here, what amounts go into each one of these 2 payroll journal entries. Remember, the first one that we're going to have is going to be for salaries and wages expense, and that's going to be at the full amount. So if you're the only employee and you make your expected paycheck is, let's say, $1,000 a month, then salaries and wages expense would be $1,000. But of course, that's not what you're receiving in cash in your paycheck, right? You've received a paycheck. The amount that you actually get in cash is significantly less than what your contracted rate is, and those differences are due to the taxes and any other withholdings. So salaries and wages expense is $10,000. We have withholding taxes payable. For $13.20, we were just given that amount. Of course, the order that we record these withholdings does not matter. We have FICA taxes payable. So even though it's FICA and Medicare, we typically just refer to this as FICA taxes payable. And for this, we need to multiply the $10,000 payroll expense, or the salaries and wages expense, times 7.65, or 0.0765. And we get FICA taxes payable $765. The company is withholding union dues on behalf of the employee. So we need to record union dues payable of $88. And now the difference is the cash that is actually, the payment that's actually made to the employee. This is their paycheck, right? So $10,000, subtract out the $13.20, the $765, and the $88, these 3 withholdings, and we get the amount of the cash payment to the employees, $7,827. Now you might be wondering, why did we ignore the federal and state unemployment taxes? We've ignored it just for now while we're recording salaries and wages expense. Remember, federal and state unemployment taxes are actually part of the company's payroll tax expense, and we're going to record that next, simply because I didn't have enough room on that slide. So the next 2 journal entries that need to be recorded, one for salaries and wages expense, and a second journal entry that needs to be recorded for payroll tax expense. And we need to know what goes into payroll tax expense. So we can't book the amount just yet. This is going to be the sum of all of the payroll tax payables. And what payables does the company incur? Well, remember the entry for the FICA taxes payable, this is the, and we don't have to write it in our journal entry, but this is the employee's portion. But the company also has to pay 7.65% on themselves. So one withholding that we have is the FICA taxes payable, the employer's portion. And it'll be for the same amount. It'll be the $10,000 times 0.0765. Again, remember this is the employee, you don't have to write this down, but just so we know, this is the employer's portion. 765. And then there are other components of payroll tax expense. It's the employer that's responsible for the federal and state unemployment taxes. So let's record those separately. FUTA taxes payable. Remember, the employee is not responsible for this, only the employer is. So we have the full 10,000 times 0.008. Remember, it's less than 1%, so 0.008, and that will be 80 for the FUTA taxes payable. And then for the state or SUTA taxes payable, we have 4% of the 10,000, or 400. So what is the total payroll tax expense? I'm going to add up the 765, 80, and the 400, and the total payroll tax expense is 1,245, which should be moved over because that is, of course, a debit. It should be shown separately from the credits. 1,245. Let's move on to our next employee-related liability, compensated absences. Compensated absences refer to paid absences for vacation, illness, and holidays. So the employees are taking time off, but they're getting paid for it. So we're going to consider that time off salaries and wages expense, even though the employee is not actually working for us. We need to keep track when these days accrue in one accounting period, but are used in a future accounting period. We need to track, we need to accrue the expense and record the liability, not when the time is taken, but they're recorded when the paid time off is earned. So consistent with accrual accounting, it's kind of the foundation of these journal entries is the time that when the employee is earning the time, that's when they're earning the benefit. So the company needs to record a liability and the expense. And then in the future accounting period, when that paid time off is actually used, we don't record an additional expense, but we need to reduce the liability and make the payment. A couple of details that we need to know and some terms that we need to be familiar with related to compensated absences. We accrue the liability, so we said when it's earned, but we have to have the following conditions, specific conditions that exist. The employer's obligation is attributable to the employee's services, so it's earned, and the obligation relates to rights that either vest or accumulate. They don't have to do both, but either vest or accumulate. So what does this mean? Vested rights are rights that are not contingent on future services. And here's an example. If an employer says for each year that an employee works, we're going to contribute 8% of that employee's salary to their 401k, but the employee can only use those benefits. They only actually have legal right to those benefits once the employee works for the company for 5 years. Well, some employees are not going to stay for the full 5 years. They'll walk away, and those contributions that never vested are completely lost by the employee, so the company does not have the payable. What would the company do in this situation? Well, they would have to say, I think, on average, 40% of our employees stay the full 5 years and vest, so they would record a liability for 40% or whatever their estimated portion is. All we need to know is that what this means, that vested rights are those that are not contingent, and if they're not contingent, then the full amount becomes an obligation. So these rights can either vest or accumulate. Accumulated rights may be carried forward to future periods. Typically, we're thinking about sick pay and vacation time. earn them in one period, and oftentimes people don't take them or don't take them all, and so those rights carry forward to the future period. Of course, we need to record a liability for that. If those rights were lost, if any sick days that aren't taken in the accounting period are lost, then of course there's no liability because there's nothing that can be used up in the future. So the obligations has to relate to rights that either vest or accumulate. Payment of the compensation must be probable. And lastly, the amount that the company is going to owe can be reasonably estimated. Now, when we're recording entries for compensated absences, we record an increase to typically salaries and wages payable, to salaries and wages expense. Although a company could have its own separate compensated absences expense, but we're just going to throw it all into salaries and wages expense, and we're going to increase the liability account, salaries and wages payable. And again, a company could have a separate payable for compensated absences payable, accrued vacation time, accrued sick time. We're going to put it into salaries and wages expense and salaries and wages payable. So record an entry to increase salaries and wages expense and salaries and wages payable during the period that the benefit is, and really important, is earned, not used. And typically we're going to record the amount at the employee's current salary, right? The employee could earn some vacation time this period, use that vacation time in 2 years when the salary is higher. So we don't know what the salary is going to be when the employee takes the vacation time. So we typically are going to record it at the employee's current salary. And then when they take it, if that salary has gone up, then we just record an additional expense for the difference. The employee earns a higher salary during a future period when the benefit is used. Record, this is what I just said, an additional expense. For the difference between what was accrued previously, that initial salaries and wage expense at the salary at the time the entry was booked, and what is paid out, we're going to reduce salaries and wages payable for the amount that was previously accrued at the employee's salary at the time the entry was booked. We're going to take a look at an example. Amutron Inc. employs 10 individuals and pays each one $480 per week. Employees earned 20 unused vacation weeks in 2020. Now that's total. For all 10 employees, there was a total of 20 unused vacation weeks. In 2021, the employees used the vacation weeks, all of them, but now they earn $540 per week. Amutron accrues the accumulated vacation pay on December 31st, 2020 as follows. So remember, we're going to record the expense in the period that the time was accrued or earned by the employees. And it's year end. We haven't paid them out. We're going to pay them out when they take the time next period. So we're going to credit salaries and wages payable. And the amount of our journal entry is going to be the 20 weeks times the amount that the employee's salary in effect at the time when that vacation time is earned, $480 per week. So 20 times 480, 9,600. Debit salaries and wages expense, 9,600. Credit salaries and wages payable, 9,600. Now, in the next year, 2021, the employees take the time. Remember, they're not working, but we're still going to pay them. And so we're going to credit cash, right? We're paying our employees. We're going to reduce the cash payment. We're going to reduce the salaries and wages payable of 9,600. So I'm going to start with reducing a liability. I need to debit salaries and wages payable. They took all of the vacation time, so I can reduce it the full 9,600. However, if the employees only took, let's say, 15 of the vacation weeks, I would debit salaries and wages payable, not 9,600, but 15 weeks times the accrued amount, 480. Let's skip a line. Remember, we're going to have to record an additional salaries and wages expense because the amount that the company accrued $480 is different than the amount that they have to pay out of $540. That's going to be, and difference is going to go to salaries and wages expense. So we increase that expense. Let's hold off on the amount of that expense. And let's take a look at how much we're actually going to pay out to our employees. What is this cash payment going to be? We're paying out our employees for 20 weeks that were used. And we're multiplying it not by the $480. That's the amount that they earned that they were paid when they earned the vacation time, but now they're making $540, so we need to multiply this by 540. So 20 weeks times $540 per week. The cash is credit. We pay out $10,800, and then that difference goes to salaries and wages expense of $1,200. But another way to think of this $1,200 to salaries and wages expense is the 20 weeks times the difference between the salary they're being paid out at and the salary that the company accrued the liability, accrued the amount for. So the difference between $540 and $480, $60 times 20 weeks, $1,200 for additional salaries and wages expense. Let's move on to bonus agreements. So remember, with the vacation time and sick time, we said, well, if the employees are earning it this period, that's when we have the expense, even if it's going to be paid out next period. Same principle applies with the bonus agreements. So bonuses are typically determined by the year-end income, the income for the current, let's say the year 2020. We don't know that until the end of the period, so the payment won't actually be made until typically January, February, or March, based on the year-end's income. So payments to certain employees, certain or all employees in addition to their regular salaries or wages, these are the bonuses, and unpaid bonuses should be reported as a liability. Typically this is going to be a current liability because they're usually going to be paid out after the books are closed and we can determine exactly what was income for that most recent year end. The expense and the liability are recorded in the period that they are, really important, that they are earned, not in the period that they are paid out. Let's take a look at an example. Palmer Inc. shows income for the year 2020 of $100,000. It will pay out bonuses of $10,700 in January 2021. Palmer makes an adjusting entry dated December 31st, 2020 to record the bonuses as, and now this could either go directly to an account called bonuses expense, but we're going to record it directly to salaries and wages expense. $10,700, and then of course the credit is not going to be to cash. We haven't paid it out. Pay it out in the next accounting period, so this is going to credit to salaries and wages payable. And then when the payment is made sometime in January 2021, records the payment. Of course, we're going to reduce this liability we had accrued at year ends, prior year, prior accounting period, and then pay out the cash. It's pretty straightforward. And our last topic relates to current liabilities is current maturities of long-term debt. We just need to know one thing. The portion of bonds, mortgage notes, and any other type of long-term debt that matures within the next fiscal year. So it's December 31st, 2020. We're thinking about what debt comes due by the end of 12/31/2021. That portion of the debt is going to be recorded as current, and some of the portion of it could relate to debt that maybe the majority is long-term, but the portion that needs to be paid off within the next 12 months after the balance sheet date is reported separately as a current liability. So if you think about a company that has a mortgage, and every time a mortgage payment is made, some of that is to principal, and it might be a 20-year mortgage. Each year, we need to think about how much of the principal is going to be paid off within the next 12 months of the balance sheet date. That portion is going to be shown as current. The remaining portion of the mortgage will be shown as long-term. Now, that's as long as you're using cash to make the payments in the next fiscal year. If the company is planning to, let's say, sell off some buildings or equipment in order to meet its mortgage payments, It's not requiring the use of cash within the next year, so then that would continue to be reported as a long-term liability. Not just selling assets, but if you're selling assets, issuing stock, or refinancing the short-term debt into more long-term debt, you would not separate out the current portion of the long-term debt. But as long as you're paying with cash the current portion of the debt within the next year, you would list that in with the rest of the current liabilities. And that includes the discussion of current liabilities. They're generally classified as current liabilities as long as that debt is not going to be paid. So you might have